Welcome to Venture Podcast, presented by VNTR, the world's leading investors community, the place to learn from VCs and capital allocators.
I always say the weight of the money is through the people. And I think that as an operator, you really learn what it means to put a team together that understands how to build a business, build a product, build a strategy, and execute on that. And as I said, they started out as pay equity, and it's moved on to opportunity, overall compensation management for being able to match your compensation strategies to your business strategies, which is a huge deal for very public companies. So their companies, their customers include every industry from Walmart and airlines, Siemens, Aon, the New York Stock Exchange, you name Microsoft.
Hey guys, welcome to VNTR podcast. Today we are hosting Diane Fraiman. And Diane, welcome to the VNTR podcast. We would love to learn from your experience as a VC. And maybe you can share some insights to your background first. And then we have questions that we're going to ask you to guide this discussion. So welcome.
Thank you, Yuri. It's great to be here, and I appreciate the opportunity. Yes, I'm Diane Fraiman. I'm a managing director with Voyager Capital. We're an early stage B2B technology investor in the Pacific Northwest of the U.S. My background is as an operator. I spent 25 years before going over to the dark side of venture to basically do a lot of sales, marketing, and business development for both very large public companies. I started with a company called Digital Equipment Corporation, which some of you may know, and ultimately ended up in an Israeli security company that was Sequoia-backed in the Bay Area that was called Sanctum. Through that process, I really learned how to grow businesses. And so when I went over to venture, it was something that I found to be extremely fun from the standpoint that I could help other early stage entrepreneurs understand how to look forward, get to scale, and really grow their go-to-market.
That's really interesting how you kind of took those experiences as an operator, because I think a lot of people, speaking from younger people, essentially, they want to go straight into VC, and it's quite hard to kind of do that without that kind of inside knowledge. So I guess my question is, what are the kind of main things that you learn operating that helps you kind of in that venture space, looking at it from the outside?
Yeah, Nico, it's a good question. I often get asked by folks that are, as you said, interested in venture so how do I do that? And, the reality is, in my case, it was very serendipity. I never went looking for it, and we can discuss that. But, given that my background is as an operator first versus going to business school, saying that I want to be a VC when I grow up, having a lot of experience in spreadsheets and waterfalls and financial aspects of the business, to be honest with you, I believe that the way you build a business is I always say the weight of the money is through the people. And I think that as an operator, you really learn what it means to put a team together that understands how to build a business, build a product, build a strategy, and execute on that. And so I happen to be very biased towards the operator experience. Doesn't mean that the folks that come up through the more traditional route of business school into wanting to do venture isn't a good path. It's just one that isn't my experience. And so from the standpoint of the advice I always give is go get some operator experience. I think it really helps you understand really how difficult it is to build a great business. The best product doesn't always win. The smartest people don't always execute well. It really is a matter of putting all the pieces together. And I think by being an operator, you actually learn that from the ground up, just from experience.
Great. And so when did you kind of join the VC route? Right, it's kind of we did analyze the company that you joined. Looks like you didn't start it, right? It's kind of you joined 10 years into the VC firm, right?
I did. Voyager was founded in 1997, and it was originally always an early stage company. But when it was founded by the three original founders of the firm up in Seattle, Washington, they basically looked at early stage really across most of the country. And what we learned over Fund 1 and Fund 2, I joined in Fund 3, and you're right, Yuri is about 10 years into it, was that number one, focusing on first institutional rounds was really where the sweet spot was for us. And at the time, the nomenclature has all changed. At the time, that were Series A's. So Series A's were the first institutional round. It was at the point where you had board creation, where you usually had, you were beyond the concept. You had a first V1 product, maybe V2 out in the market. Maybe you had early revenue, but you clearly had early customers. And at the end of the day, it was at the point where you were looking at how do I get to product market fit and scale. That now actually is called a seed round. But, as I said, came in as an operator. And when I sold my last company down in the Bay Area, and my husband and I moved back up to Portland, Oregon, where we had lived prior to that, I really thought that I was going to be a consultant, that I would sit on some boards, and it would all be very nice. And the guys up in Seattle at Voyager basically found me primarily because of the last opportunity that I had that was in security. So the Israeli security company that I mentioned previously sort of was what caught their attention. And so they started having me look at some security companies for them to give them advice, to give them feedback. And ultimately, as I like to say, we dated. We dated for about a year. I was a venture partner, so that was part-time. We sort of walked the streets in Portland and Seattle and looked for really great deals. But I got an idea of what it was like to be in venture. And the thing that I learned, which was eye-opening for me, is that when you take venture capital out of Silicon Valley, off of Sand Hill Road, down in the Bay Area, it's actually a business that looks a little bit different. It's one that is, I felt, a little more collaborative with the entrepreneurs. It was the way that I always felt that relationship should be in the boardroom. And so I really sort of sat up and said, this is an interesting business. It allows you to see a very diverse group of entrepreneurs in technology. And it really played to what I enjoy, which is the go-to-market, the building great teams, the ability to execute inside of large enterprises, which is what I did growing up in the operating world. And so as we dated, ultimately we married, and I came on board full-time as a managing director. And as they say, the rest is history. We're right now raising Fund 6. So we've gone from 3, 4, 5, and we're now raising Fund 6.
Did the fund they added a new partner in a way to the fund? So how did you guys negotiate how you guys split the pie?
Yeah, so we are, so there are 4 managing directors, myself and 3 others up in Seattle. I'm the only one that's in Portland. And we're all equal partners. So unlike some venture firms, again, down in the Bay Area, especially where there's very much a hierarchy that exists, and they're much larger and the funds are much bigger. We're a $100 million fund. We're all equal. So we all have equal carry. We all are equal players on the playing field, which means that we're highly collaborative and supportive of each other as it relates to growing our business.
And do you guys make a collective decision when you guys invest, or each partner has their own kind of segment that you focus on?
So we do make collective decisions. We've got a voting strategy that basically is what we call N-1. So of the 4 of us, and we've got some junior partners who also participate in this in the due diligence in the conversations, but the 4 of us basically all vote on whether or not we're going to put a deal in place. Now, usually what happens is obviously one of us or maybe 2 of us working together will source that deal, will nurture that deal, will do a lot of the due diligence in the beginning to bring that deal to the partnership. But when we get to the point where the partnership is now all involved in getting to know the entrepreneur, getting to know the market, getting to know the team, what we usually do at the end is we divide up all the due diligence so that everyone's got a feel for what's going on. And then at the point where it's time to vote, we're all knowledgeable as to what we're voting on. So while it is usually spearheaded by one of us, just depending on geography or focus, all of us ultimately become involved in that deal before we write the check.
How do you source deals usually?
No, listen, let's start with where, Yuri made the point about the firm has been in place since 1997. I mean, we've been around for a while. We've been in the Pacific Northwest, Washington, Oregon, Western Canada. We've been in the region for a very long time, and we have a strong reputation with entrepreneurs. We have a strong reputation with the service providers. We are very involved in the ecosystem, whether that be the universities or the research labs or the incubators and accelerators. So having time in the geography and having a track record has basically allowed us to get deal flow from that community. There is no question that we still try to proactively source things that maybe isn't bubbling up as fast, but I would basically say a good 80+% of our deal flow is coming from within the community, within the geographies that we work.
Do you make geographical exceptions if it's like phenomenal company approaches you just because of your thesis, but again, they're not aware of the geographical thesis?
So yes and no. The pandemic changed things dramatically, where the thesis, the investment thesis on geography prior to the pandemic was pretty firm. It wasn't that obviously 100% of the company was based there, but pretty much you could see where the headquarters were. You could see that the CEO or the early management team was very much a part of our region. That's obviously changed as a result of the pandemic, where we've got people scattered everywhere. Having said that, we do very much still believe in having some basis in our region as sort of the anchor tenant for making an investment. Now, often what will happen is we'll get phone calls from other parts of the country because of our reputation in certain vertical markets, and they'll say, "Are you interested in us?" I would say most of the time we'll explain to them that we don't make investments in New York or Colorado or California. Having said that, we will sometimes say to them, if they're early, if you move your company to the region, if you move to Seattle or Portland or Vancouver, BC, that we will consider it. And what we find is that, and we only say that on ones that we think are super cool. When we do that, we've had companies move to our region. We had a company move to the region from Germany. We've had a company move to the region from North Carolina. So, we will put that out there. But we very much look for companies that from a regional standpoint have some basis, some root in the region that we support.
Is the geographical focus because of the network and support you guys provide, or is it just proximity to the founders?
It's all of that, Yuri. It's so first and foremost, we always take a board seat in our core investments. We believe, we work hard for our money, and from the standpoint that we believe that this is all about being able to get to scale, since we are that first institutional round, there will be other rounds. And so we believe that what we do really, really well is understand what an early stage team needs, understand what an early stage CEO or founder team needs, and therefore being close to proximity to where they are makes that relationship stronger, makes our network more valuable to them. And it clearly from get to the money, because this is all about making money, we believe that the region has really good foundational metrics in terms of the amount of money it takes to start a company, the amount of money it takes to grow a company, and the valuations, which are extremely reasonable vis-a-vis the Bay Area or other parts of the country. So, it is, from our standpoint, a very rich region in talent. It obviously is the cloud epicenter of the world, with Amazon and Microsoft and Google. Actually, Oracle, Baidu have their cloud headquarters up in Seattle as well. So it's rich in talent, it's rich in developer talent, but it's also, from a proximity standpoint, we believe is really the center of where we know how to get to success quickly.
And when you look at startups or opportunities in general, have you got like a framework or a structure, or would you say it's kind of more art at this stage?
Art, luck, science, it's a little bit of everything. We do have a framework, but that notwithstanding, art and luck is always, experience, sensing it, feeling it. Having said that, there's clearly a science to it as well. We spend time really in three foundational areas. One is helping to build what we call high performance teams. So usually when we invest, there's a founding team. Someone's the CEO, maybe someone's heading up technology, whatever. There is maybe a small team. Usually it's the developers in the beginning. There might be someone on the business side. So first thing we focus on is really being able to look at high performance teams, helping that early founding group build those next 3, 4, 5 heads that are going to be critical to getting to meet those milestones. So that's one thing. Second thing we focus on quite a bit is go to market. The product, the technology, we're going to do due diligence on. The product either works or not. It's either interesting to us or it's not. It's either in a crowded market or it's not. So the technology, where, of course, the founders normally come to us and go, look how beautiful our technology is. And we want to make sure it's beautiful, and we want to make sure it's disruptive, and we clearly want the innovation. At the end of the day, the most beautiful product does not always win. And so focusing on the people and the go-to-market, how are you going to extract dollars from people's wallets, is really where we spend a whole lot of time in the beginning. And it is a process for us. And the final thing that we do is what we call the partnership ecosystem. So we believe, even though ultimately it may be 5, 6, 7 years down the road before there's an exit for this company, we start to introduce partnerships very early on. Now, those strategic partnerships could be early customers. They could be people that basically are an end user or a channel as an early customer. But often what happens is those relationships, by introducing them early on, ultimately end up being in the play at the point where we get to exit, because they've also watched the company grow. And again, from a strategy standpoint, that works very well for us. So, high performance teams, go to market, and this partner ecosystem are three things from the science part of it, is part of our strategy and how we help these companies grow.
You guys have a very specific thesis of enterprise software, right? Or B2B enterprise software. So partnerships are very valuable piece that you bring, especially early on. Kind of the sales cycle is so long. It's kind of, how do you speed up the sales cycle, or like what else you bring to these teams?
It really just goes back to what I just said. We focus very well on having the right people in the right seats who understand how to sell to large, complex enterprises. Now, there's no question that the first deals that are closed are usually inside the founder's ecosystem. It's customers that they know, it's companies that they've worked with, it's people, they're looking for that referenceable account. They're looking for those first 2, 3, 4, 5 referenceable accounts. They may be for highly discounted amounts. They may be for free. But at the end of the day, usually at the point where we decide we're going to put money in, those first early referenceable accounts are in beta of some sort, if not paying customers. So it from there goes back to what we said. It's having the right people in the right seats. And if they're not right, helping the founders basically understand how to change that quickly, number one. And number two, it's really looking at go-to-market strategies in terms of good product marketing. Very important to me specifically. The growth marketing engine in terms of making sure you're not spending too much money, but you're spending some money once you've got some proof points to be able to promote yourself, et cetera. And so, we spend a lot of time on people and process, assuming that the product works, right? Now, of course, a product is always evolving. The roadmap is always growing. We spend a lot of time making sure that that roadmap and those metrics are in place. But again, you can have a fantastic product, and if you don't know how to get it to market, it really doesn't matter.
Could you share a little bit about the ecosystem that you have in Oregon, and kind of what is the evolution in kind of since you started? There was a lot of change or not much change. It's kind of how's it growing there in Oregon?
This is the United States, so there's a lot of change. So we'll just sort of put the put the basis on that for a moment. Oregon is a really interesting ecosystem. Even when I was an operator and living down in the Bay Area, all of the big companies, all the public companies down there, folks like Oracle, IBM, Symantec, EMC, Salesforce, they all had teams up in Oregon, up in Portland. And the reason was twofold. One, great developer talent. And number two, it got the teams out of the home office to remove them from some of the politics and all that goes on to allow them to actually innovate faster. And so this is a history in Oregon of having sort of these groups, these teams up there of super smart innovators and developers that were building product for very large public companies. And over time, those teams realize, well, why are we doing that? Why aren't we building for ourselves? We've got ideas, let's build for ourselves. And so Oregon sort of matured into having great developer talent to then attracting not just the developers, but the management to, in essence, be able to, again, build great companies and go to market with great product. And we've watched that evolve over the last decade or more, number one. Number two, Portland's a fabulous place. Oregon is a beautiful, beautiful state. It's sits between California and Washington State. It's got a great quality of life from a cost of living standpoint. It's clearly better than California. It's moderately better than Washington. It's a nice size. We got better weather than Seattle. But it's a beautiful part of the country. And so what we find is a lot of folks, not just from California moving north, but a lot of folks from the East Coast that look up and down the West Coast. They basically say, where do we want to build our company? And they choose Portland for the quality of life, the cost of living, and great talent.
Easy commute as well to Seattle or Silicon Valley.
Well, it really is. In fact, I laugh sometimes, having lived in the Bay Area. You can sometimes get to Silicon Valley. You can sometimes get to Sand Hill Road in Silicon Valley faster from Portland than if you're on the east side of the Bay in San Francisco and have to drive. So
if you use your private jet to Palo Alto, for sure.
Yeah. Well, not quite there, Yuri, but it's a nice idea. It's a nice idea.
Yeah, no, it can be a smaller Cessna type of jet, for sure. Yeah.
And I'll let you know when I get that.
Yeah, I have a few friends in the Bay Area that use their small jets to move around.
It's a lovely idea. Ain't me.
Yes, I've been to Oregon multiple times. Indeed, beautiful. Portland is a beautiful city, and Oregon is, the nature is fabulous.
It is. It's stunning.
Yeah, it's sounds like you guys, built 6 funds. And how did you learn how to work with LPs, or what was your journey in terms of the LP relationship?
It's a super question, Yuri, and especially to me specifically, since I didn't grow up or start when the fund started. I came into this and it was new. So when I joined the firm, the partners at the time were just raising Fund 3. So I really didn't get involved with Fund 3 at all. I got involved very much with Fund 4, Fund 5, and obviously Fund 6. I think there are two answers to that question. One, I started out as a salesman. I mean, this is selling. And at the end of the day, we're selling a product no different than when I was selling hardware or software for, a company that I worked for. So this is sales. It's a people business. This is relationship. This is long-term relationships. This is trust. And obviously, if you believe in the product you're selling, in which case our firm and the fund and our ability to make money for the LPs, because that's really what this is all about, is making money, then you're selling and you're convincing people. And sometimes it takes a while, right? There are folks that talk to us in Fund 4 who said, we want to watch you for a fund, who then invested in Fund 5. There are folks in Fund 5 who basically are now committed to Fund 6. So it's a long-term relationship, that, you have to nurture, you have to communicate with, you have to believe in what you're selling. And once I figured out that really is what's going on, I felt very comfortable in doing it. I didn't have the relationships going in initially. I've built my own relationships. But in terms of being able to feel confident that what we're selling to our LPs is something that we believe is going to return money, I feel very confident about that. So it makes the process, it makes the action of selling to LPs, of winning their trust, easier.
Did you have also regional focus for the LPs? Are they mostly from your region?
Our LPs are all over. Yeah, no, our LPs are all over the world. We've got them all over the US. We have them in Europe. We're talking to some in Asia Pac. No, our LPs are all over the world. And, that's obviously important just from the standpoint that people recognize the value of the region. They recognize the value of the differentiation of the regional strategy versus just Silicon Valley. And they recognize the experience that the firm brings to the table.
How do you kind of position yourself compared to Silicon Valley funds? Like you're saying that, that LPs will see the benefit of investing in your fund, regionally fund in your region versus Silicon Valley, where, lots of great companies being established and growing.
Absolutely. Yeah, it's so firstly, listen, no question that the number of companies, the quality of companies are fantastic down in the Bay Area, as is the competition for that business. And the result of the competition for that business is, with all due respect to my colleagues down south, are crazy valuations sometimes for what we think are unrealistic amounts of money. And when you do early stage, in our case, early stage B2B tech, I like to say to the entrepreneurs is this is a game of milestones and metrics being met and being able to scale a company so that you can continue to get up rounds, right? So you will get money from us, and there will need for more money, and probably 2, 3, 4 times maybe. And so if you don't start the game at a reasonable starting point, reasonable valuation for reasonable amounts of money, what'll happen is even if you do everything correct, you're still going to miss some milestones. This is early stage. This is experimentation. These are usually first-time teams. This is highly disruptive technology. Stuff happens, and it could happen for a multitude of reasons that have nothing to do with you not doing the right thing. And so one of the things that we always say to entrepreneurs looking at the Bay Area, potentially in a term sheet there versus what we provide up in our region, is very fair, very competitive valuations and money that are going to start you off in a situation such that you have room to meet your milestones and metrics and continue to get up rounds as you go. And so, as we all know, and you talk to lots of VCs, things got once again, and it will happen again, very frothy over the last couple of years. And what you've got is a lot of entrepreneurs who are now in a situation either can't raise or down rounds because, again, they did everything right, but stuff happens and they missed some milestones. The market changed. And now you're basically looking at a down round, which at that point, the investors are totally in control. And so the difference between Silicon Valley, and it's not just our region, it's really a lot of the countries which is doing great investing at this point, is it's a more balanced, more reasonable ecosystem. Now, again, there is nothing to say what goes on down in California isn't phenomenal for the market, but it's not the only game. And you can build great companies anywhere in the country. You can build great companies anywhere in the world if you've got the right partnership and you've got the right team that's going to basically take the money you raise and meet those milestones and metrics to get you to that next round. And that's the game that we're playing here. And so we believe that the math is in our favor vis-a-vis the folks in California, and we've proven that out. Do we see less deal flow? Sure. But do we have less competition for that deal flow? Absolutely.
And speaking about deal flow, I mean, obviously you've got a lot of entrepreneurs coming to you with ideas and things like that. But what kind of resources or tools do you use to assess opportunities and trends that maybe entrepreneurs don't tell you about?
Don't tell us about, they don't tell us everything? Oh my God, crazy idea. We do extensive due diligence. So, obviously within our team, we don't know everything about all technologies. And clearly we, in many cases, know the entrepreneurs by reputation that come to us because they've been in the ecosystem, but we don't know them. We do extensive due diligence, and we have a very big network of technologists that will get in and kick the tires on the product, that will look at not only how that product is being built, but what the engineering processes are for how they are evaluating roadmap development, delivery, et cetera. We do a lot of reference checking on the people. As I said before, we believe the way to the money is through the people. So we spend a lot of time both from the references that the entrepreneurs give us, as well as back channeling through our own network. So we do a lot of diligence in that. And then finally, we do a really good amount of diligence on the market that they're going at. So we build our own market maps. We look at the ecosystem that's also trying to sell into it. To be honest with you, we always have an eye on the exit. Who will buy this company, since the majority of our exits are M&A. And so we're always, from the very start, we may not get it right. We may not even getting close to getting right, but at least the thesis going into these investments is that we have in our minds an idea of what companies would be interested in this technology or in this solution at scale. And so we spend a good amount of time in doing technology, people, and market diligence with a fairly wide net of folks that are in our world that we can call upon to help us.
So you were talking about up rounds, like there is certain roadmap, they need to raise more and more and more. Do you see a lot of companies that don't find enough capital in your region for follow-on rounds that they go to?
Yeah, I think it's all over right now, Yuri. I think that you can talk to folks down in the valley and you can talk to folks all over the country, and they're having to work a little harder for the money now than maybe 18 to 24 months ago. So it really isn't any different where we are than it is down south. It is, it's as I said, it's less frothy than it was 18 months ago, 24 months ago. And as a result, investors are looking for more proof points. They're looking for more, proof that the milestones or metrics have been met, or that there is a team in place that's going to get you to the next. So it is not just up in our area. It is really, I think, right now everywhere where there's been a reset. In all honesty, I think the reset is good. I think that the reset brings everybody down a notch here in terms of let's calm this down. Let's, really look at fundamentals for building great companies, and let's not get ahead of ourselves in terms of trying to throw huge valuations on companies that really haven't even gotten product market fit yet, because that's not doing anybody any service at this point. So it's not just where we are. I think it's everywhere right now that the reset has been very real. And the good news is I think it has calmed down a bit even in the last 3 months or so. I think the reset's done. I think everyone understands what the new levels are. And so we're sort of back to a normal pace.
There's a huge hype at the moment. Just speaking about external things you can't really control, there's obviously a huge hype about AI at the moment. So it'd be great to get your inside opinion on that, and then which particular niche within AI you're most excited about, or not.
So, just so that we're all clear, AI is not new. We've been investing in AI-driven technology. In fact, we've invested in AI tools even a decade ago. Now, it wasn't Gen AI, and obviously this is a huge disruption in technology right now. But AI is not new, and Gen AI by itself is not the answer to all requirements. It's still a combination of the traditional AI and obviously Gen. AI. It is, every deck we see now is a .ai. Everyone's a .ai. Everyone thinks that, it's going to solve everything. I'll tell you from my standpoint, I think there are two, and I'm going to oversimplify, I think there are two phases to this, and we've seen the first phase very, very quickly, and it's what I call the AI sparkle dust. All of our existing portfolio companies added AI sparkle dust. They took the open APIs, whether it was chat or whatever, they basically added it inside very quickly, in 4 to 6 weeks, inside their existing products, depending on what that solution was, whether it was dynamic content, whether that was responses, whether that was doing surveys, whatever it may be. They basically were very quick to add the AI sparkle dust into their products. And that was key. That was important. It number one, made it more efficient for usually most of these teams to be able to do certain things like respond, like dynamic content, et cetera. But more importantly, it really showed their commitment to stepping up for where the market's going. So the sparkle dust is good, but the sparkle dust is not what's going to actually move the needle, I believe. The really cool stuff, I think, is where what we're going to see over the next 12 to 18 months. We're starting to see it now, where there is AI platforms being built from the ground up to solve very big, complex enterprise problems. And obviously, this is where you hear about it, whether it's in healthcare or finance or pharmaceuticals or anything, all markets. But you can't just throw sparkle dust at that. The really cool stuff takes time to build. And so there's a little bit of back to the future here. As I said, over a decade ago, we were investing in AI tools, in DevOps for AI. We've sort of come back to that again, i.e. the new Gen AI development environment is once again starting with a slew DevOps types of solutions and security and infrastructure types things. And so we're seeing a lot of that come to market. Personally, for me, I sold enterprise. I like enterprise, and I like solving problems I understand. And so what I'm looking forward to and what I'm beginning to see now is AI solutions in different markets built from the ground up that are enterprise ready, solving very interesting problems in end user markets that are not just in the developer realm. And I think over the next 12 months, we're going to see this cross industry, and it's going to be exciting, right? But it's going to take a little bit of time. This is not a matter of, look, here's Gen AI, fix everything, do really cool stuff. It takes time to build great products. And so I think we're going to see it over the next 12 months.
That's a nice breakdown, because it seems like every app that I've used in the past 12 months has just got this new little AI button.
Literally.
It doesn't seem that, I guess, revolutionary, really.
It's sparkle dust, but,
exactly.
But people want it, and it's helpful. Like, it's not that it's not valuable, but it's not revolutionary. I mean, it's not like taking you to a different level of solution, but it's useful. It's cool.
But I guess as well, it does make it a lot harder for smaller companies. So, for example, Zoom, I think it now has a AI assistant that summarizes your meeting, right? And that's a small feature for Zoom to build, but that is an entire business, like Fireflies, etc. So it does make it very harder for the kind of smaller companies that don't own that user experience already to come in and compete, because Zoom, for example, has shown that it's quite easy just to spin up a little feature that is an entire business.
Yeah. I mean, in all honesty, entrepreneurs who think that they can basically launch a feature that is going to be highly disruptive because they've got a cool feature, and it's not because of Gen AI. This is true in anything. We'll often look at presentations at decks being sent to us, at people presenting to us. And, the question is that a feature or is that a solution, right? Is this a feature that somebody else can easily put into their product? Or is there a solution here? Maybe it starts with a wedge in a certain market that we can understand how this thing really is going to differentiate quickly. Now, there is no question that you can almost 100% of the time sit there and look at a pitch on any market, any presentation, any solution, and say to yourself, well, could Zoom do this? Google do this? Salesforce do this? Oracle do this? Could they do this? Because they're sort of in the adjacent market, and because they've got all this other, and they've got money, and the answer, of course, you could always get yourself to a point of saying, yes, they could. But historically, if you just look at the industry for all the years that I have, they might, but there's a good possibility they might not. And they might not because they can't innovate fast enough, because they've got a whole lot of customers they've got to support with their existing technology, that unlike your Zoom example, which I would call the sparkle dust category, that it's going to take them longer to basically put teams together to basically innovate into new solutions. And so this is where you get to the make versus buy. And if you didn't believe in make versus buy for these large companies, you probably would never write a check to any of them, because you'd always believe that someone's going to be able to get there sooner that's got more money and more resource. So, your Zoom example is a really good one. Gong is doing a similar thing as well. I mean, all of these siloed MarTech apps, what I would call marketing technology, all these silos are adding the sparkle dust to basically give you better visibility into the customer. I'm looking at a deal right now it's very much a Gen AI deal. It's a smart team built from the ground up. And what they're looking at is all the silos. They're looking at Gong, Zoom, Salesforce, Demand Gen. They're looking at all of them. And they're saying, we're going to look at all of the consumer data coming across, We're going to take all of that into the data lake and use the technology to basically surface where you may have churn, retention issues, expansion issues, et cetera, and not just the one silo. Now, Zoom can do it for Zoom, but is Zoom doing it across the rest? Gong can do it for Gong. So you have to sort of sit there and say, yes, each of these silos are going to innovate, right? But is that fixing the problem, or is that just adding to the problem? I would argue in the marketing technology world, MarTech, that if you look at a MarTech piece of, a market map that the analysts do, et cetera, you can't even read the logos anymore. I mean, it is a mess. And I've done a fair amount of MarTech investing back 10 years ago, 7 years ago. I did none in Fund 5. And the reason is it was just more silos. Now, having said that, I think that now MarTech may be one of these markets that is very much ripe for disruption because of Gen AI, but not because each of the silos are going to add more features. I think something has to bust those silos to really be the disruption that may occur. So it's really a matter, I think, of how you evaluate the opportunity and how you see it for the long run.
You mentioned that most of your exits are through M&As, right? And so kind of how do you influence, like you're on the board seat in many of these companies, how do you help these companies sell at the right price at the right time? Or kind of which companies do you recommend to not get sold and wait for like a potential IPO?
Yeah, listen, Yuri, I mean, this is probably where the art does come in. Timing is everything on this stuff. Obviously, there are comps, right? I mean, we watch market comps very, very closely. We clearly watch market dynamics in terms of which markets are moving, which markets are consolidating, why are they consolidating. We are always watching the competition as it relates to, being able to understand where we're positioned in the competition and what that competition is doing as far as exits go. So it's a complicated set of conversations. If you take it from the worst case, the one thing you never want to have happen is to run out of money, but it happens, right? It happens that with all best efforts to build a great company, it doesn't happen. Whether it's competition or you missed the market or the product really never worked or you never got traction or the team didn't do a good job, on the one end of the equation as you try and cut your losses early on versus At what point do you say we're not going to pump more money in and we're going to find an exit? Those exits are usually based on technology and talent. It's because you really haven't gotten a whole lot of market penetration. If you go to the other side of the equation where you've got a company that's just flying, year-over-year growth, market penetration, they've created a moat around them. What you begin to happen usually years before the exit is you start to see who the potential buyers are swarming around. Usually they start out maybe as partners. They start out as strategic partners. You do a little bit of the date before you get married. And at the end of the day, you can sort of see where that is going to go. And of course, ultimately you want to create some sort of competition in that. But that's a very different set of conversations at the board level for where the timing is right. Now, again, we're in this to make money. So the majority of our exits are M&A. Firstly, there aren't that many IPOs out there. But secondly, our LPs are very happy getting returns sooner than later for a fabulous price than sitting there and saying, but we got an IPO. IPOs can be fabulous, but it's not the only way to make money.
What is the lifetime of a company that you invest in average? It's not
the average is 7 years. We've got some that went 12. We've got some that went 2. 2, you get great IRRs. 12, you're hoping you can get it out the door. That 5 to 7 range is normally where we'll start to see some really good exits.
So kind of in enterprise software, do you recommend to get the strategic money from corporate VCs? Or is it
not initially
be hurtful?
Yeah, not initially. We shy away from strategics in the first couple of rounds, even 3 rounds. I mean, again, every company's different, every market's different that they're in, but we'll normally shy away from strategics for the first few rounds. Now, ultimately, putting a strategic in there that usually have an observer seat, they never lead, et cetera. It can be valuable. I sold a company to Verizon several years ago that was a drone, the software management layer for commercial drones. Verizon basically came in on the second round, really the third round if you looked at it after the pre-seed. They took an observer seat. And ultimately, when we went out for the next round after that, they took it off the table because they had a seat at the table. They had watched it. They took it off the table. So that happens, and it was a very good exit for the company, and it turned out to be very good for the technology. But, that's more of an exception than a rule at that stage. Usually we push it further out.
Yeah, totally makes sense. It's kind of, you're the first female VC that we are interviewing, and we are hosting lots of events around the world. Like this year, we hosted 83 offline events and more than 50 online events where we bring investors to investors. And we see that female VCs are kind of very small part of our community. And kind of what is your perspective, how to increase the amount of female VCs and what kind of communities are there for female VCs or like someone that wants to become a VC? What do you recommend?
It's a very big question, Yuri. Very big question. Yeah. So listen, I've been in technology for a very, very long time. And as I said in the beginning, I started out selling computers, sales, marketing, business development. I was around the world. I have for most of my career been the only girl in the room, which is just a fact. And that's not to say that there aren't just a lot of really phenomenal women in technology. When I made the jump from being an operator to venture, it was, in all honesty, a step backwards, even from when I was an operator. I think it's gotten better, but better is relative. Better is relative to zero. It's gotten better because more women want to go into venture and more younger women are coming out of business schools saying they want to go into venture. And there is pressure on venture firms to have more women. the reality is that, and it's not just women, it's people of color, it's very imbalanced. And anyone who says differently is just not looking. So I see more and more women that are coming into the venture world or are coming into other asset classes as well, by the way, not just venture, but we're talking about VC right now. But it takes time, right? They come in as whatever the title is, associates, principals, partners, but just not managing directors. And that takes time. And this is a boys' network. It's still a boys' network. And so what you're seeing, like with Jillian and others, is you're seeing more and more women-started, women-driven VC funds. And I think that is fantastic. I think it's the tip of the spear of we're not going to wait for you to help us. We're going to do it ourselves. I think that there are some phenomenal women VCs out there that are leading the charge with these firms and that they are going to change the dynamic, but it just doesn't happen overnight. It is a career, and you just don't jump from zero to, managing director because you want to. And so I think it's getting better, but it's got a ways to go, and there's a lot of areas for discussion as to why and how it gets better in the long run. I mean, it's not an easy discussion.
Are you part of some female VC community already?
So I sent you an email on this because I said that may be one question that's not really great for me. I believe I am incredible in nurturing and mentoring women, both on the operator side and the finance side, the venture side. I am personally very, very committed to doing that and have always been. And I think that is known. As far as joining large groups of women that are networking in this to do it, not a great joiner on that. So I've got networks of women venture friends who we collaborate and we talk. Not great on the big group joining thing. Mm-hmm. So not a great question for me, but I am, I hope, seen as being easily accessible, readily available, and always willing to have a conversation to help any women, either on the operator side or on the venture side, figure out how to navigate this world.
I think leading by action, leading by example, tip of the spear, like you say, that's the best way to do it, right?
I think so. I mean, I'm no smarter than anybody else. The only thing I've got going for me is a lot of years of experience. So, and as we started the conversation, I came up as an operator. I didn't come up as a finance person. I am terrible, as my partners would tell you, at doing spreadsheets and waterfalls. I don't like it. But the good news is I've got partners in my firm that help me with that. So I just don't do it. But in the beginning, I had imposter syndrome thinking, I can't be a good VC if I don't know how to do the waterfalls. I was like, oh my God, what if they find out? And, I found out, it's okay. I bring other things to the table. And, experience, it's like any other business. Experience counts. And so to your comment, what I do bring to the table is experience. I've won, I've failed, I've lost, I've gotten a lot of luck. That's what I can help other women understand.
So I guess the last question is, what are your biggest successes or misses in your career of investing in startups?
Misses? No, never any misses. My God. Well, I'll tell you the success, or some successes first. And most recent, there's a company that extremely excited about. They are Seattle based because even though I'm in Portland, our partnership, we're regional, and so I do any of it. It's Seattle based. It's a company called Syndio, Syndio. It's a woman CEO. She was not the founder. She was a hired gun CEO. She came in after the founders. The angel investors put her in. The company does workplace equity. Basically, if you were to redefine that as it relates to a technology solution, they do a compensation decision support solution. Their wedge when they came into the market was pay equity. So they came into the market with a solution that took all of the HRIS data from Workday, ADP, SAP, et cetera, and they gave you, the HR team, all of the dials, the bells and whistles, the flexibility to do the what-if analysis around your pay environment for all your employees. And prior to them, this work was being done by consultants. Basically, the board or the CEO every year would say, we need to do the annual survey, and they would hire a consultant, and the consultant would say, pay us $150,000, and they would deliver a report. And, the day after the report was delivered, you'd hire another 2 people, and that report was out the door. So they came into the world 3.5 years ago doing pay equity. And Voyager led that round, co-led that round with Emerson Collective. This was Louise Powell Jobs' venture arm, and they're very interested in impact investing. We co-led it with them. It was right at the lockdown of COVID. So the team basically started growing this business during lockdown. We brought Bessemer in 10 months after that to add, and then the 3 of us did an inside round to make sure they had lots of money through the pandemic and beyond. And they went from when I put the initial money in, they were at about $2 million ARR, and they'll now do about $35 million this year, 3.5 years later, and growing. And as I said, they started out as pay equity, and it's moved on to opportunity, overall compensation management for being able to match your compensation strategies to your business strategies, which is a huge deal for very public companies. So their customers include every industry from Walmart and airlines, Siemens, Aon, the New York Stock Exchange, you name Microsoft. So all industries who have grown with them over the last 3 years. It's highly disruptive. They have strategic relationships with Workday, ADP, SAP, who are watching them. So it goes back to some of what we discussed before. And it's a phenomenal team. I love that it's a woman CEO. She is remarkable and, just is addressing every milestone, every metric with just a diligence and I'd say strategic eye on both what could go wrong and how do we prevent it, as well as how do we scale faster. And that's just like a whole lot of fun to be part of. It's also interesting to your previous question that the board, it's the only board I'm on that is predominantly women, and that's a blast. So that's super unusual.
The question was more which great companies you missed or said no, and they became a huge success.
Well, I was going to say, interestingly, I haven't necessarily had one of those, although our firm has. We've had a few of those in the firm. There was one in Portland that it wasn't a huge success, but it did have a disproportional exit to what I would have thought would have happened. So there was one company that it took them 10 years to grow it. I did another investment in a similar market at the same time. Did they get lucky? Yeah, they built a nice company. I think the exit was disproportional to what the market said, but they got it, and that's one that we all sit and go, did we miss it? I don't think we missed it. Did they get lucky and that would have been nice? Yeah. It was like, how the hell did they get that money? But the business was it wasn't that we missed an opportunity of how they grew. They grew to exactly where we thought they were going to be. They happened to have a nice exit. It happens.
Amazing. Yeah, it's kind of, again, thank you so much for joining us. Lots of great insights into the VC and enterprise software. We also, like most of the VCs that we interviewed, they're not focusing on this niche. So thank you so much for sharing your expertise and knowledge. I hope that, our listeners will learn from it. And thank you so much.
You're welcome, guys. It's good talking to you. I appreciate it.